the market broke. Why there is a $25 gap between US and China. $25, that's all it takes to expose the collapse of a 100-year-old system. Right now, at this very moment, the same asset is trading at two completely different prices. One price in New York, another in Shanghai, and nobody can close the gap. Not the hedge funds, not the central banks, not even the algorithms built to catch exactly this kind of fracture. Something fundamental has broken. The invisible hand that kept global markets aligned has stopped working. And what you're about to discover isn't just about numbers on a screen. It's about the architecture of the world economy, quietly dismantling itself. The question isn't if this affects you. The question is, how much time do you have before it does? Welcome to Financial Inspection. If you've built something in your life, a business, a portfolio, a legacy, then what we discuss here matters to you. We don't chase headlines. We examine structural shifts. Now, if you value this kind of strategic analysis, the kind that helps you see around corners before the crowd does, then I'd invite you to subscribe to this channel. Think of it like reserving your seat at a table where serious economic discussions happen. No noise, just signal. Before we proceed, I'm curious, where are you watching this from today? Are you in North America, Europe, Asia, the Middle East? Drop your location in the comments. It helps us understand who's paying attention to these fractures and where. Now, let's begin with part one. On March 15th, 2025, a trader in New York stared at his screen and saw something that shouldn't exist. Crude oil futures were trading at $68 per barrel in the United States. The exact same contract, the exact same delivery date, was trading at $93 per barrel in Shanghai, a $25 gap. In a functioning market, this gap should disappear in seconds. Traders would buy low in New York, sell high in Shanghai, and pocket the difference. This process, called arbitrage, is supposed to keep global prices aligned. But the gap didn't close, it widened. By the end of that week, the spread had grown to 27s, then 29s. Financial institutions sent urgent memos to their risk departments. Something in the machinery of global commerce had stopped working. This wasn't the first warning sign. Experienced analysts had been tracking smaller distortions for 18 months, a $3 gap here, a $5 divergence there, but $25? That crossed into territory that textbooks said was impossible. The business community began asking questions. CEOs of manufacturing companies called their CFOs. Import-export firms reviewed their contracts. Hedge fund managers pulled their teams into emergency meetings, because this gap represented more than just a pricing anomaly. It represented a fracture in the system that had governed international trade since World War II ended. For decades, the global economy operated on a simple principle. Prices converge. If wheat costs more in Paris than in Chicago, someone ships wheat from Chicago to Paris until the prices equalize. This mechanism kept the world economy integrated. It allowed businesses to plan. It made long-term contracts possible. But integration requires infrastructure. It requires open shipping lanes. It requires banks that can process cross-border payments. It requires governments that allow capital to flow freely. And in 2025, that infrastructure was failing. The trader in New York couldn't simply buy oil in the US and sell it in China. His bank couldn't process the transaction without triggering multiple regulatory reviews. The shipping company couldn't guarantee delivery without navigating a maze of new customs requirements. The insurance company wouldn't cover the cargo without charging prohibitive premiums. Each barrier added cost. Each delay added risk. And when the total cost of moving oil from New York to Shanghai exceeded $25 per barrel, the gap became permanent. This was new. This was dangerous. Analysts pulled up historical data going back 50 years. They found temporary gaps during crises. The 1973 oil embargo, the 2008 financial collapse, the 2020 pandemic. But those gaps always closed within weeks. Markets always found a way to reconnect. This time felt different. The gap persisted through April, then May. Traders stopped trying to arbitrage it. They accepted it as the new reality. Two separate markets, two separate prices for the same product. Business executives began calculating what this meant for their operations. An automotive manufacturer in Detroit realized his production costs were now 15% higher than his competitor in Shenzhen. Not because of efficiency differences, but because they operated in different price universes. A semiconductor company in Taiwan found itself trapped between two pricing regimes. It bought materials in dollars. It sold products in yuan. The gap meant its margins evaporated overnight. The financial press covered the story for a few days, then moved on to other headlines. But in boardrooms across the world, strategic planners understood they were witnessing something historic. The global market, the single unified system that had defined international business for generations, was splitting into two, and the split was accelerating. Commodities weren't the only assets affected. Currency exchange rates began showing similar distortions. Bond yields diverged beyond historical ranges. Even digital assets, supposedly immune to geographic boundaries, started trading at different prices depending on which platform you accessed. The question everyone started asking wasn't, when will this gap close? The question became, what happens when businesses realize it never will? Because if prices don't converge, if markets stay fractured, then every assumption about global business strategy becomes obsolete. Every supply chain gets redesigned. Every investment thesis gets rewritten. Every competitive advantage gets recalculated. The $25 gap wasn't just a number on a screen. It was a signal that the economic world order had fundamentally changed, and nobody knew what came next. 3 months before the gap appeared, a quiet meeting took place in Basel, Switzerland. 17 central bankers sat around a conference table. No cameras, no press releases, just a closed-door discussion about a problem they couldn't solve publicly. The topic was simple. Money had stopped moving, not completely, not dramatically, but the pipes that carried capital between East and West were clogging. Transactions that once cleared in hours now took days. Payments that used to flow automatically were getting flagged for review. The financial plumbing of globalization was backing up, and nobody wanted to admit it was intentional. A banker from Frankfurt described the situation using careful language. Regulatory compliance requirements have expanded, he said. What he meant was, governments were making it deliberately difficult to move money across certain borders. A representative from Singapore nodded. His institution had seen the same pattern. Wire transfers between New York and Shanghai now required 17 separate compliance checks. Each check added delay. Each delay added cost. The friction was invisible to most people, but devastating to traders trying to arbitrage price differences. This wasn't an accident. This was architecture. For 18 months, both governments had been building walls, not physical walls, financial walls. Each new regulation added another brick. Each new restriction made cross-border transactions slightly more expensive, slightly more risky, slightly less attractive. The process had a name in policy circles, strategic decoupling. But decoupling sounds gradual, managed, controlled. What was actually happening was faster and messier. Consider what a trader faced when trying to close that $25 gap. First, he needed to move dollars from a U.S. bank to a Chinese financial institution. That transaction now required approval from the Treasury Department's Office of Foreign Assets Control. Processing time, 3 to 7 business days. Then he needed to convert those dollars to yuan, but currency conversion required using the official exchange rate, not the market rate. The official rate carried a built-in 4% penalty. That was $4 of the $25 gap, gone. Next came the actual commodity purchase. Buying oil in the U.S. and selling it in China required export licenses. Obtaining those licenses meant proving the transaction didn't violate any of 47 different sanction regimes. Legal review, 2 weeks minimum. Then shipping. A tanker from Texas to Shanghai took 35 days. During that time, prices could move. Insurance for that voyage had tripled in cost because underwriters now classified cross-Pacific routes as elevated risk. Another $3 of the gap, gone. At the destination port, new customs protocols required complete supply chain documentation. Every barrel had to be traced back to its source. Every transaction had to be verified. Customs clearance, formerly 2 days, now took 2 weeks. By the time a trader added up all the costs, all the delays, all the risks, the $25 gap wasn't enough. He'd need a $40 gap to make the arbitrage profitable. So he didn't try. Nobody tried. The gap remained. But the barriers weren't just financial. They were physical too. Shipping companies faced a new reality. Routes that previously carried goods in both directions now moved cargo only one way. Container ships that once returned to China, filled with American soybeans, now returned empty. The economics of shipping collapsed. Freight costs doubled. Warehouse operators in both countries reported the same phenomenon. Strategic stockpiling. Companies were building 6-month inventories instead of running lean, just-in-time operations. They were preparing for supply chains that could be cut without warning. This was the invisible restructuring. While politicians talked about maintaining trade relationships, businesses were quietly building separate operational systems. One for the American market, one for the Chinese market, with minimal connections between them. A pharmaceutical executive in New Jersey explained it to his board this way. We're not planning for disruption anymore. We're planning for permanent separation. His company was building duplicate manufacturing facilities. One in North Carolina, one in Guangzhou, same products, same specifications, but completely independent supply chains. The cost was enormous. The alternative was worse, because the regulatory environment wasn't stabilizing, it was accelerating. Every month brought new restrictions, new compliance requirements, new reasons why transactions that used to be routine now required executive approval. The trend line pointed in only one direction, toward complete financial segregation. The sophisticated investors saw it coming. They'd been repositioning portfolios for 2 years, reducing cross-border exposure, selling assets that depended on integrated markets, building positions that would profit from fragmentation. But most businesses were caught unprepared. They'd built their entire strategy around the assumption that global markets would stay connected, that prices would converge, that capital would flow freely. That assumption was now dead. The $25 gap was simply the most visible proof. It was the moment when theory became reality, when abstract policy decisions manifested as concrete price differences, and the mechanism that created this gap wasn't breaking down accidentally. It was being deliberately dismantled, piece by careful piece. The bankruptcy filing arrived on a Thursday morning in June. Nobody expected it. The company wasn't small. It wasn't struggling. 6 months earlier, analysts had rated it a strong buy. Revenue was growing. Management was experienced. Everything looked stable. Then the gap appeared. And within 90 days, a 70-year-old manufacturing business collapsed. The company made industrial pumps, high-precision equipment used in oil refineries, chemical plants, and water treatment facilities. They sourced raw materials from suppliers in both markets. They sold finished products globally. For decades, this model worked perfectly, until it didn't. The procurement manager noticed the problem first. Steel prices in his U.S. facility were climbing, while prices at his Chinese factory were dropping. Not by small amounts, by margins that made his spreadsheets look broken. He called his supplier in Pittsburgh. Why are we paying $1,200 per ton when the global benchmark shows $950? The supplier's answer was simple. That's not the global price anymore, that's the China price. Your price is different. The manager didn't understand. Steel was steel. How could the same grade of material have two prices separated by 20%? But it did. And that divergence destroyed his business model instantly. The company's competitive advantage had been optimization. They'd spent years perfecting a supply chain that sourced components from the cheapest provider globally, assembled them in the most efficient facility, and delivered to customers just in time. That system assumed price convergence. It assumed a shipment from Shanghai and a shipment from Cleveland would cost roughly the same once you factored in logistics. The assumption was now fatally wrong. His Chinese factory could buy steel at $950 per ton. There was no winning position. The gap had created a strategic trap. By July, the company's margins had evaporated. By August, they'd burned through their credit line. By September, they were filing Chapter 11. This story repeated across industries. A textile manufacturer in Vietnam found that cotton prices diverged so severely that her cost structure became unpredictable. She couldn't quote prices to customers with any confidence because raw material costs might swing 15% depending on which market was accessible that week. An electronics distributor in Singapore discovered his inventory was worth different amounts depending on which direction he shipped it. Components purchased in Shenzhen and sold in California generated profit. The same components purchased in California and sold in Shenzhen generated losses. His warehouse had become a financial roulette wheel, but the cascade didn't stop at physical goods. Financial derivatives started malfunctioning. Futures contracts assumed that spot prices would converge. Options were priced, using models that predicted normal arbitrage. Hedging strategies relied on correlations that no longer existed. A pension fund in Toronto had hedged its commodity exposure using standard techniques. Those hedges assumed global price unity. When markets split, the hedge stopped working. The fund lost $340 million in 3 months. Not from bad market timing, but from using strategies designed for a world that no longer existed. Insurance companies faced a parallel crisis. They'd written policies based on historical volatility patterns. Those patterns assumed markets were connected. Now, price swings in one market had zero impact on the other. Risk models that took decades to build became worthless overnight. A reinsurance executive in Zurich described the problem in a private memo. We are flying blind. Every assumption underlying our pricing is invalid. The corporate planning departments were in chaos. A CFO at a multinational pharmaceutical company explained the situation to his CEO. We have manufacturing in both markets. We have sales in both markets. But we can no longer treat them as one business. They're two separate companies that happen to share a logo. The CEO asked the obvious question. Can we consolidate? Pick one market and exit the other? The CFO shook his head. If we exit China, we lose 30% of revenue. If we exit the US, we lose access to capital markets. We're trapped in both. This was the new reality. Companies were forced to maintain duplicate operations, duplicate supply chains, duplicate management teams. The efficiency gains from globalization, the whole reason for building integrated international businesses, were reversing. Investment banks started publishing research with a new framework. They called it the bifurcation premium. Companies with exposure to both markets now traded at discounts. Investors were punishing complexity. They wanted pure plays. Single market companies with no cross-border entanglement. The gap wasn't just changing prices. It was changing valuations. It was changing which companies thrived and which companies struggled. A venture capitalist in Palo Alto noticed founders pitching different businesses. 6 months ago, startups emphasized their global reach. Now they emphasized their regional focus. We only serve the North American market had become a selling point, not a limitation. The cascade was rewriting competitive dynamics in real time. Companies that had spent billions building global scale were watching that scale become a liability. Meanwhile, smaller regional players who'd never expanded internationally were suddenly at an advantage. They had no exposure to cross-border complexity, no assets trapped on the wrong side of the divide. By autumn, the pattern was clear. The $25 gap wasn't an isolated anomaly affecting one commodity. It was the leading edge of a systemic transformation. Every price was splitting. Every market was fragmenting. Every business model built on integration was being stress-tested to destruction, and the cascade was accelerating. Because once businesses accepted that markets wouldn't reconnect, they stopped trying to bridge them, they stopped building cross-border partnerships, they stopped signing long-term contracts that assumed price convergence. The gap was becoming permanent, not because it was impossible to close, but because everyone had stopped believing it ever would. In October, a quiet transformation began in boardrooms across the world. It started with a memo, a single-page document circulated among Fortune 500 CEOs by a consulting firm that specialized in geopolitical risk. The memo had no dramatic title, just a date and a simple statement. Strategic assumptions requiring immediate revision. The memo listed 12 principles that had governed international business since 1990. Principles like markets converge, capital flows freely, and supply chains optimize globally. Next to each principle was a single word: obsolete. One CEO in Chicago read the memo 3 times. Then he called an emergency meeting with his executive team. "We've been managing this wrong," he told them. "We keep treating this as a temporary disruption. We keep waiting for things to return to normal. But what if this is normal now?" The room went silent. His CFO spoke first. "If that's true, if we're really looking at permanent market separation, then our entire strategic plan is built on a false foundation." The CEO nodded. "Exactly. So we start over. Today." This conversation was happening simultaneously in hundreds of companies. The denial phase was ending. The adaptation phase was beginning. But adaptation required answering a difficult question. How do you build a business strategy when the fundamental rules of global commerce have changed? The first companies to respond did something counterintuitive. They stopped trying to optimize across borders. Instead, they built completely independent regional operations. A technology manufacturer in California made the decision in November. They would run 2 separate businesses, one serving the Americas and Europe, one serving Asia and the Middle East. Same brand, same products, but zero operational integration. The CFO ran the numbers. Duplication would increase costs by 23%, but attempting to maintain integrated operations in a fragmented market was increasing costs by 30% and creating unpredictable risk. The decision was clear. Separation was cheaper than integration. Other companies adopted different strategies. A commodity trading firm in London built a new business model around the gap itself. They couldn't arbitrage between markets anymore, but they could help clients operate within each market more efficiently. They hired separate teams. One team focused exclusively on Western markets. Different office, different systems, different risk models. The other team focused on Eastern markets. The 2 teams never shared positions, never coordinated trades. They operated as completely independent entities under one corporate umbrella. The firm's founder explained the logic. "We're not trying to bridge the gap anymore. We're accepting it exists and building expertise on both sides of it." This approach required a fundamental shift in mindset. For 30 years, international business strategy focused on integration, finding synergies, leveraging global scale, optimizing across borders. That playbook was now backwards. The new playbook focused on segregation, minimizing cross-border exposure, building redundancy, accepting inefficiency as the price of stability. A pharmaceutical executive described it as strategic localization. Her company was moving research, manufacturing, and distribution into regional clusters. Each cluster could operate independently if connections were severed. The capital expenditure was enormous. Building duplicate facilities, hiring duplicate teams, maintaining duplicate inventory. But the alternative, remaining dependent on cross-border flows that could be disrupted without warning, was worse. Financial institutions adapted differently. Banks that had offered global services started specializing. Some banks focused exclusively on facilitating transactions within the Western financial system. Others built expertise in Eastern markets. Very few tried to do both. A banker in Singapore explained why. Maintaining relationships and compliance frameworks in both systems requires double the infrastructure. Most banks can't justify that cost, so they're choosing sides. This created new opportunities for the few institutions willing to maintain dual capabilities. They couldn't arbitrage prices anymore, but they could charge premium fees to the small number of clients who still needed to move capital or goods between separated markets. Hedge funds redesigned their entire approach. Traditional strategies assumed correlations between global markets. Those correlations were breaking down. Funds that continued using old models were hemorrhaging capital. The successful funds rebuilt from scratch. They created separate portfolios for separate market systems. They stopped hedging between markets because hedges didn't work anymore. They accepted that diversification now meant diversifying between disconnected markets, not within a connected global market. One fund manager in New York put it bluntly to his investors: "We're not managing one portfolio with global exposure anymore. We're managing two portfolios that happen to share the same investors." For smaller companies, adaptation was harder. They didn't have capital to build duplicate operations. They couldn't afford to maintain separate teams in separate markets. Many made the painful decision to exit one market entirely. A software company in Austin chose to stop selling in Eastern markets. A manufacturing business in Shenzhen stopped pursuing Western clients. The efficiency of focus outweighed the revenue loss from reduced geographic reach. This created a new competitive landscape. The winners weren't the biggest companies anymore. They were the most adaptable, the ones who recognized the shift earliest, the ones who rebuilt their operations fastest. By December, a pattern emerged. 3 types of companies were surviving. First, regional specialists, companies that operated in only one market system. They had no cross-border exposure, no complexity from navigating fragmented markets. Second, bifurcated giants, large corporations with resources to run completely separate operations in each market. They accepted duplication costs as necessary overhead. Third, gap specialists, smaller firms that built expertise in helping others navigate the separation. Consultants, specialized logistics providers, boutique financial intermediaries. Everyone else was struggling. The middle ground, companies too big to be regional specialists but too small to afford full bifurcation, was becoming untenable. An economist at a policy institute published a paper analyzing the transition. His conclusion was stark. We're watching the most significant reorganization of global commerce since the 1940s, and it's happening in months, not decades. The $25 gap was no longer just a price differential. It had become a dividing line, a border, a permanent feature of the economic landscape. Business leaders stopped asking when it would close. They started asking how to build profitable operations on either side of it, because the gap wasn't going away. The world had split, and the only question that mattered now was, which side of the divide would your business survive on?